All right, good afternoon, traders. This is Christian from it's Tribeca Trade Group, and it is Monday, March 23rd. So it looks like I'm having an Excel problem, and I just wanted to. Oh, there it goes. Just unfroze. How about that? Luck of the draw, finally. Something going wrong. I'm just kidding. All right, so where did we finish on the day? The S&P finished down 2.7% today. Again, you kind of have to put this in context from where we were last night. We've had a number of Mondays that we are starting the session limit down, and we're struggling with that situation. We did hit limit down in the overnight market, but it was kind of, I don't want to say smooth sailing the rest of the day, but the volatility wasn't as extreme as it was last. Again, trying to be a little bit positive, but the volatility wasn't as extreme as it was, and there was also another Vix divergence. So we'll talk about that in just a second. Again, pretty wide performance depending on what asset class you were looking at or what index you were looking at, because small caps finished down 1.7%, so they actually did a little bit better. And the Qs actually did much better today too. The Qs for a good portion of the day were positive, but Congress kind of I'm gonna fault them for it. You could fault other reasons and so on and so forth. But I'm going to say that this was partly Congress's fault. The market, I think, was expecting them to get something done, and they, of course, disappointed. So that will get pushed off to later in the week. Hopefully, we'll get another vote before Friday. But I wanted to make sure I just touched upon that point because that was one of the events of the day. The other thing that kind of helped us in the morning was that the Fed is basically, doing everything that they can. So that was the one part of the puzzle. But I think the fiscal package has to come to kind of relieve the short-term pressure. So I think a positive, what's going on with the Qs, that's been showing relative performance now. If we look at these charts, first of all, this is what the S&P is doing. It is down 3.2% right before futures close here in 2 minutes. So it's actually headed a little bit lower here. Weekly chart. One of the things that jumps out at me is this 2103. I put this out on Twitter yesterday. We talked about it. We talked about it in the. Sorry, I've got Bloomberg squawk going in my ear, so let me turn that down. But we talked about this in the weekend video as well. It doesn't. This VPOC doesn't necessarily, 100% have to be taken out, but it would just be another one of those boxes to be checked off, basically saying that, hey, we really don't have another one of these behind. Remember how these virgin point of controls work. It's a high area of volume that we have not revisited, right? So it's almost like a gap. Right, and this would basically say if we get down to 2103, that kind of fills this gap. And remember, the market has a memory to it, right? Where a lot of buyers and sellers have previously met up, even though it's a long time ago. It's the market still remembers these things, right? So I don't know if that's going to be the last one that will need to be taken out. We've hit a number of these things on the downside, but they are not going to tell you like how much buying and selling pressure. There are further ones down here, so it's just one of those things where you kind of just have to wait to see how this is going to work its way out. Another thing to kind of note on the daily chart is we really haven't had any confirmation. I've talked about some things that you probably hear me at this point tired of talking about the same things, but these same things have kind of worked quite a bit. Like I've talked about the 5-period moving average. We had that one day that was Friday last week, where we almost had a close that was kind of retaking the 5-day. But again, there's really not a lot to kind of hang your hat on to say a low is in. So I will go over a couple other things. I did want to go over that NASDAQ chart. And let's look at the Qs. We can go ahead and look at the Qs. Now the Qs also did make a new low today, but did not make a new closing low. So an intraday low, but not a new closing low. There's also this 162 VPOC. Again, even though the Qs look a little bit better, and I'll go to the weekly chart for this too. There's still so they're showing some relative strength, and I can show you this too on Bloomberg if I bring up. Let's see if this one will work. That one's not working. Let's check this out here. So a couple relationships to check out here. And if we go Q's SPY, right, you can see that this has really been outperforming. So that's what I'm talking about by relative strength. Q's over SPY has been basically breaking out, been very strong. Also, another one that I've been looking at is the IWM. So there are some things that are changing around a bit. Right, I talked about this weeks ago, saying that basically IWM needed to stop going down, much faster than SPY. So this has been outperforming a little bit IWM. So again, it's one of those things that I think is a bit better to see. Does it mean that we're going to reverse? So here's where when we're looking at some of these factors, right? I've got VIX divergence. I'm going to talk about that next. Credit spreads. You kind of have to take, I think it makes sense to look at each one of these. I call them like factors. But they're all, number one, they're all not going to line up perfectly, right, for a bounce. But they're all like telling a little bit of a different story, right? And you want to put those stories together, and basically, or maybe it tells it's a chapter in the book, right? And you want to put the chapters together and then be able to make a conclusion at the end of it. So let's continue to go through, right? So let's talk about. I want to talk about the negative first. I like to get the negative out of the way and then get to the positive. But if you look at credit spreads, what I did was I put in credit spreads. This is credit spreads is the white line, and I put this together with the SPX, right? So of course, everybody, including myself, looking at 2008 and where credit spreads got. We've now went over several levels over the last 5 years where credit spreads are continuing to widen out. And if we just look at this in isolation without the SPY in there, you could see, and looking at just a 1 year, these things are widening out. Right, which is again, I will give you the conclusion of this. That's basically tells you there's risk in the market. There's risk in the fixed income market. Risk is increasing, not a good thing. Like to see credit spreads widen tells you that you've got a problem in this market. So that has to stop ripping up to the upside. So again, this is an important factor for me, and why I'm not like. Jumping into kind of add risk right now, because there's certain things that don't look good. Even though there are some things that are making a little bit better sense, right? When we look at the VIX, for example, right? The VIX for the second day in a row actually went down versus the S&P. So let's move this to just week to daily. Right, so we've got a second day where this tried to go higher. Again, I didn't love, even though the VIX was down on Friday, I didn't really like that hammer bar, because sometimes a hammer bar into support, we can actually start going back up that way. Looking at this as a perfect, as a chart pattern rather than, hey, maybe the VIX is, without, putting too much intuition into this, just looking at the chart pattern itself and not reading into it, right? Normally a hammer bar on like the 20-day moving average is usually nice support, and then it goes higher. So we did start the day higher, but again, the VIX kind of sold off throughout the day. So, again, it's something to keep an eye on. It is a divergence. I put together this weekend. I put together like 3 tweets on Sunday, maybe Sunday afternoon, talking about VIX and S&P divergence. Remember, when usually the S&P goes down, right? The VIX goes higher. Right now, we've had 2 days of divergence, so it doesn't mean that it's marking a low. We had this go on a few times back in 2008 before the final last divergence, which was in March of 2009. And there the S&P made a definitive new low, and the VIX barely even budged that day, and hadn't actually budged for like a couple weeks. So that's why I'm not 100% convinced that this divergence is going to work. But it's one of those factors that I look at and saying, hey, I will put this on the positive side, right? And that's another way you can kind of think of it as like, you know, basically putting positives on one side of a table and negatives on another side. And right now it's kind of mixed. I've got a couple positives, but I've got probably a little bit more negatives. So let's continue with the analysis. Another thing that I saw that I thought was interesting too was if we look at high beta versus low beta, I do actually want to see high beta outperform low beta or low volatility, right? These two ETFs, SPHB is the S&P high beta ETF, and that's in the numerator, and in the denominator is SPLV, which is low volatility. So you started to see for a while really the low volatility equities outperform, which again I think is if we look at this a little bit further, I think this is typically what happens is some of the low volatility names hold up better, right? We saw this back here as well, and if we look at, I don't think we can go back as far as 2008 because these ETFs are not that. But let's put in an S&P chart. That's otherwise it could be a little bit noisy. So let's see if we can figure this out. Let's normalize this. All right, so here we've got this little divergence going on. Notice that also when this started to move up, we put in I think we started to put in a bottom here in the beginning of 2006 as well. So it's something, right? So this I would put in the positive column, right? So finally we've got like a couple things that are a little bit more positive. Last week we had nothing, right? It was really hard to find something that was positive. So again, stick with the process and let these things kind of come to you and work their way through. Again, the magic word is the P word, is patience. Before you think about anything else, patience, right, is basically what we're trying to do here, and let this work its way through. And everything else that I've been talking about, like basically you have to try to survive and advance through these days. The volatility in individual names is still, it's crazy. Even though that the overall Qs were basically unched, there's a lot of names that are just all over the place. If we look at the movers in the S&P today, it's very difficult to make sure that you're all aligned in the positive, because there's a lot of good things that happened in terms of some of these names that rallied. The gaming stocks did very well. I see ATVI, TTWO, EA. The semiconductors was a big thing today. They had some really nice relative outperformance today. Where did the semis end up finishing for the day? Up 3.7% for the day. I mean, that's really strong when the market's going down that much. I mean, that's a good thing, right? So, again, one day is not a trend. So we'd like to see this kind of continue, and I'd like to see the credit spreads stop blowing out and kind of move in a little bit. Netflix was also up. On the flip side, if you got caught in any of these names, like look at Macy's, down 20% today. So, and again, with the S&P down, there was quite a few names that actually did pretty well. And if we look at the Qs as well, the movers for the day, right, you could see that WDC and Western Digital and Microchip, that's not exactly risk off, right, to see those names up that much. But you also had a few things like ISRG, and the medical device companies were pretty weak today. Some biotech, Biogen was down. So it's kind of a mixed bag, and it's just, I think, a difficult market to find the stocks that are going to be the winners. Today, like I said, I think made a little bit more sense from other days. We also saw a lot of the stay-at-home names do very well, like the Netflix, like Zoom Video. So again, these things are logical to me. I think we actually did have one day last week where things kind of made sense, like intuitively or logically, and that was like just one day last week. So we'll see if we continue to go in the right direction. I said so. Vix Divergence, we talked about that one. No divergence in credit spreads. High beta greater than low beta today. Again, that's a good thing. Tepper, the word of the day was, he did some nibbling today, right? So I actually, if you listen to his interview, it's something that I've been talking about now for a while. They asked him, where he's actually buying into this market, and he did have a little bit more of a tech emphasis, right? I do think I think it's important to think about once we do get through this situation, what names are going to continue to do well, right? And I think that names like Amazon are going to do well. I think PayPal, which I'm still kind of stalking PayPal, but I think that people are not going to use as much currency in their pocket. They're going to be using more things like PayPal, and they're going to be using more things like Visa. Now you've got an issue with that, and the issue is that the consumer is not spending as much right now. But again, you want to be able to kind of think about things a little bit further out, and I think tech. People are going to have to continue to use tech even if they're working at home, right? They're going to have to. I'm watching very closely Apple because while they're probably going to get hit a little bit because their stores are closed, but I think people are still going to be buying, and I like the hammer bar, right? We saw on Friday, talked a little bit about Apple, how this VPOC was taken out. Well, we got a hammer bar off of this. So again, we don't know if that's going to mark the low. One day is not a pattern, so we'll have to see if this straightens itself out tomorrow with Apple. Saw a little bit of call buying, but small stuff, right? No big stuff. Gold miners had a big day today. We saw early in the day. You could look at Nugget if you like. I like to look at GDX because it doesn't have the slippage and the daily rebalancing to it, but the gold miners had a decent day today. I already talked about credit spreads, but TLT, that also I would put maybe in the negative column for the day, is that TLT was up 4%. The other thing, and I'll leave it here for the day, but the other thing that Tepper said is, which again, this is all things that we had in the weekend video. But if you are doing what his word, nibbling into the situation, what he said is, hey, we could end up, I'm not saying that this is the low, and again, I'm paraphrasing Tepper. He said, hey, we could possibly go down another 10 or 15%. And he said, well, what will I be doing if we do go down another 10 or 15%? Probably nibbling a little bit more. So I think this came up. I thought CNBC did a good job. They had a few different speakers on or guests on who talked about that. Going in a little bit at a time and dollar cost averaging into the weakness. Again, as long as you're thinking about this in terms of long term, if you're thinking about this short or if you need this money right away, then that may not be the right approach for you. But if you're looking at long term, then I agree with that. I think buying a little bit here and there. My plan is I bought one day in my long-term account last week. I will buy one day again this week, and I'll kind of look to go in a little bit at a time, not going in with 2 feet in. What I like to say is dipping a toe in, basically once a week into this. But I still think outside of some of the things that we went over, right, the coronavirus cases, that is the major situation, and we're still seeing cases increase in the U.S. So it's a process, right? They were really behind with testing. Now there's still, I think, some shortages in testing, so that has to continue to work its way through, and that just takes time. So I'll leave it there, and again, that's the whole key is to have that patience and realize that we need to get the data. Everybody talks about flattening this out, and we need to see that similar to what we saw in South Korea. I liked how Tepper mentioned that. I sent out a chart on Sunday about the overall cases are starting to they're increasing at a decreasing rate. That's where we need to get to. I think they also said in Milan today also that they were increasing at a decreasing rate. So we'll see how this develops, and the U.S. needs to get to that spot. So whether that's days or a couple weeks away, that's why you have to basically manage your risk like this every day and not get overexposed. All right, guys, thanks for watching. Have a great rest of your evening, and we'll see you tomorrow and back in the trading room.